Imagine waking up one morning, checking the news, and seeing that your country's debt has gone up by another $1 billion. Not this year, not this month, today. Sounds impossible, but that's happening right now. In fact, the world is quietly sitting on over $100 trillion of government debt. So here's the question. Who does governments owe all that money to? And what happens if they can't pay it back? Debt isn't always bad. If you borrow money to build a factory, that factory creates jobs. Those jobs create income. And eventually, the debt gets paid off. That's how borrowing is supposed to work. But governments don't always borrow to build the future. Sometimes they borrow to pay for today. Healthcare, military spending, infrastructure, pensions, disaster relief, economic stimulus. Every year, governments collect taxes. But when taxes aren't enough, they borrow the difference. Again, and again, and again. Eventually, the pile becomes enormous. Quick question. Who do you think governments actually borrow all this money from? Type your guess before I reveal the answer. Here's where it gets interesting. Governments don't usually borrow from one giant bank. Instead, they sell something called government bonds. Think of a bond as an IOU. You lend the government money today, they promise to pay you back later, with interest. Who buys these bonds? Banks, pension funds, insurance companies, investment firms, even ordinary people. And sometimes, other governments. That's right. Countries can lend money to other countries. It's a gigantic web of borrowing, and it works as long as everyone believes they'll eventually get paid back. But here's the catch. Debt comes with interest. Imagine owing your friend $10. Easy enough. Now imagine owing them $10 million. Suddenly, the interest alone becomes a problem. Now scale that up to trillions. Some governments now spend hundreds of billions of dollars every year just paying interest. Not paying off the debt, just paying for the privilege of keeping it. It's like using one credit card to pay another credit card. It works until it doesn't. You might be thinking, why not just pay everything back? Because paying it back isn't that simple. To eliminate the debt quickly, governments would have to dramatically raise taxes, cut spending, or both. None of those choices are popular. Most governments do something else. When old debt expires, they borrow new money to pay the old debt. Economists call this rolling over debt. It's perfectly normal. Until investors begin to lose confidence. Because confidence is the real currency holding the entire system together. If investors start believing a government might struggle to repay, they demand higher interest rates. Higher interest means higher borrowing costs. Higher borrowing costs create even bigger deficits, which require even more borrowing. It's a cycle. Sometimes it ends with painful spending cuts. Sometimes higher inflation. Sometimes financial crises. History has shown all three. Thankfully, most large economies have powerful tools to avoid the worst outcomes. But those tools aren't free. Every solution comes with trade-offs. Here's the surprising part. The biggest danger isn't necessarily having debt. Modern economies can function with debt for decades. The real danger is pretending debt doesn't matter. Because every dollar borrowed today is a promise about tomorrow. Eventually, someone has to finance that promise. Whether it's taxpayers, future governments, or inflation quietly reducing what money can buy. Once you see debt this way, you stop thinking of it as just a giant number. You start seeing it as a series of choices. Choices about priorities, choices about risk, and choices about the future we leave behind. Because in the end, the question isn't whether governments can borrow, it's whether they can keep the world's confidence while they do. And that's a story that's still being written.